You may feel like your financial future is out of control right now. The markets, the economy, and even retirement can all feel like they're in flux. But maybe it's not because those things are actually out of control. Maybe it's because you haven't been shown how to take control of them. Once you start to understand the structure behind all of it, that feeling begins to change. You start seeing opportunities rather than just obstacles. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist and the owner of Pointe Financial. Each week on Pointe Perspective, we step inside the analytical process behind financial decision making, breaking down how professional investors build structure, interpret the system, and create strategies designed to hold up over time. This week, we're focusing on 3 key areas. First, we'll look at what's been happening in the markets and break down how different asset classes behave. Second, we'll take a deeper look at the economy, specifically how money moves through the banking system and how that impacts lending, liquidity, and overall economic activity. And third, we'll bring it all back to your personal plan, continuing our discussion on retirement by walking through account types and discussing why tax diversification plays such a critical role on long-term strategy. Because financial success isn't about reacting faster or avoiding situations. It's about taking accountability for your future and building something that's intentional, structured, and designed to last. Over the last few weeks, we've seen some obvious shifts in the market. Certain areas, especially parts of technology and areas influenced by oil, those have pulled back. While at the same time, other areas have held up better and in some cases even moved higher. If you are heavily concentrated in just 1 or 2 areas, your experience of the market right now may feel very different than someone who is more diversified. When your investments are concentrated, volatility can feel sharper and losses can feel more immediate. But when your portfolio is spread across different types of investments, you can try to create some balance. So while one area may be down, another may be more stable, or it might even offset part of that movement. In finance, we often refer to something called a jelly bean chart. You could see this one here from MFS. It shows the performance of different asset classes over time, year by year. And what you'll notice is the leadership constantly changes. In more recent years, large cap growth stocks have been near the top. But in 2022, that same category was one of the worst performers. Commodities are another example. There are years where they're near the bottom, but in 2021 and 2022, they were among the top performing assets. You'll see this same pattern across international stocks, small caps, and bonds. There is no consistent winner. But what stands out the most isn't the top performers. It's the dark gray boxes that represent a diversified portfolio. They're almost never at the top, but they're also rarely at the bottom. They stay relatively consistent, and that is the goal. Because in long-term investing, especially for retirement, it's not about hitting home runs every year. Babe Ruth hit a lot of home runs, but he also had a lot of strikeouts. And that same approach doesn't work for a financial plan, because your retirement can't absorb those kinds of swings. So if you're concentrated in one area, you're essentially betting that you'll always be in the right place at the right time. And historically, that is very difficult to do. Now, looking deeper at these categories, most portfolios are built on a combination of a few core asset classes: stocks, bonds, cash, and in some cases, alternative investment. Each one serves a different purpose, and more importantly, each one responds differently to changes in the market and the economy. Let's start with stocks. Stocks represent ownership in companies. Historically, they've delivered higher long-term returns, but they also come with more volatility. They tend to be sensitive to economic conditions, interest rates, and expected future earnings. During periods like we've seen recently, it's not unusual to see more movement, especially in growth-oriented sectors like technology. Next, we have bonds. Bonds are loans. You're lending money to a government or a corporation in exchange for interest payments. They're often used for stability and income, but they are not risk-free. When interest rates rise, bond prices tend to fall, and that's something many investors have experienced in the recent years. Then we have cash. Cash provides stability, liquidity, and flexibility. It allows you to make decisions without being forced to sell investments at a loss. But over time, too much cash can lose purchasing power due to inflation. So like everything else, it needs to be used intentionally. And lastly, we have alternative investments. This can include real estate, commodities, hedge funds, private investments, and cryptocurrencies. They're often used for diversification and can help in certain environments, but they also come with more complexity, more risk, and in some cases, less liquidity. For this reason, they're typically intended for more experienced, accredited investors. The bottom line is, different asset classes all work together, but in different ways and at different times. What we're seeing in the market right now isn't random, it's rotation. And a portfolio isn't just a collection of investments, it's a system built with the right combination so it can try to adapt across changing environments. Next week, we'll take this one step further, breaking down how these asset classes work together and how to structure a portfolio with quality for more long-term stability. Last week, we talked about what money is, and this week we're going to talk about how money moves through the system, particularly within the banking system. Most people think of banks as places that simply hold money, but their role is much bigger than that. As we discussed last week, banks are one of the primary mechanisms through which money is created in the economy. When you deposit money into a bank, it doesn't just sit there. A portion of that deposit is held in reserve, but the rest can be lent out. When a bank issues a loan, it's creating new money, and that loan becomes a deposit in someone else's account, which means the total amount of money in the system has now increased. It's called credit expansion, and it's a core function of what's known as the fractional reserve banking system. To give this some perspective, in the United States today, the majority of the money supply is created through this lending process, not through physical currency printing. When lending increases, the money supply increases, and when lending slows, the money supply slows with it. This is one of the key ways banks influence economic activity. Their lending fuels consumer spending, business investment, and overall economic growth, but it has to be balanced. When lending expands too quickly, it can contribute to inflation. And when lending tightens too quickly, it can slow the economy. And as we've discussed before, that's why interest rates matter so much. Central banks like the Federal Reserve don't directly control spending, but they do influence it by adjusting interest rates. Higher rates make borrowing more expensive, which tends to slow lending and reduce money creation. Lower rates make borrowing more attractive, which encourages lending and expands liquidity in the system. So when you hear about rising or falling interest rates, what you're really seeing is an attempt to manage the pace of money creation and economic activity. The economy is driven less by data and more by the movement of money, and banks sit at the center of that movement. When banks are lending freely, the system expands. When banks pull back, the system slows. But interest rates are not the only factor that drives these shifts. Banks also adjust their lending standards based on risk and economic conditions. They may tighten credit requirements, reduce loan approvals, or require stronger financial profiles, all of which reduces lending even without a change in interest rates. And these changes aren't always voluntary. Policy and regulation, both at the federal level and the regional level, can influence how aggressively banks lend. And at the same time, banks are constantly evaluating their own risk exposure. So for example, during periods where economic conditions begin to weaken, perhaps there are concerns about employment or repayment risk. Like when we know we may see a contraction in the economy, banks may proactively reduce available credit or tighten standards to protect themselves and their exposure to risk. So what you're seeing is a system that's constantly adjusting from both sides. Policy influences the banks, and the banks respond based on risk. That interaction drives shifts in lending, liquidity, and ultimately the broader economy. Now, looking ahead to next week, we're going to take this one step further, diving into quantitative tightening and easing. This will be a more in-depth discussion, so if you need a refresher on the Federal Reserve and interest rates, I highly recommend going back and reviewing those videos. Let's continue our discussion on retirement. Last week, we started with the vision and what you actually want your life to look like. And now that you have a clearer idea of the destination, we need to start building the path to get there. One of the most important parts of that path is understanding how your money is held and the opportunities that creates for you in the future. This is where we stop thinking about what something looks like today and we start thinking about what it looks like 20 years from now. Because not all dollars are treated the same, and when you reach a point where new income is limited, you're going to want options. In retirement planning, we typically think in terms of 3 account types: traditional, Roth, and non-qualified or taxable accounts. Now, when you hear qualified, it simply means the account qualifies for a tax advantage. Non-qualified means it does not. Each type of account has a different tax treatment, and how you use them can have a significant impact on your long-term outcome. Starting with traditional accounts, this includes things like traditional IRAs, 401ks, and other pre-tax retirement plans. With these accounts, you typically receive a tax deduction when the money goes in, but when you take distributions later, that money is taxed as ordinary income. So you're deferring taxes today with the understanding that you'll pay them in the future. These accounts also come with required minimum distributions, or RMDs. At a certain age, you'll be required to start withdrawing those funds. The government allowed that tax deferral for a period of time, but eventually they want to begin collecting. These accounts can be beneficial for individuals who expect to be in a lower tax bracket in retirement, although in practice, we're actually seeing that less often. Next, we have Roth accounts. These include Roth IRAs and Roth 401ks. With Roth accounts, the tax treatment is reversed. You pay taxes on the money before it goes in, but if structured properly and after the required holding period, those funds can grow and be withdrawn tax-free in retirement. The benefit isn't always obvious upfront, but over time, especially as those assets grow, the ability to access those funds without taxation can be very valuable. It's also important to note that both traditional and Roth accounts typically come with age restrictions. If funds are withdrawn before age 59 and a half, there may be a 10% penalty, with some limited exceptions. Ideally, these accounts are designed to be left alone for long-term growth. And then we have non-qualified accounts. This includes brokerage accounts, savings, and other taxable investments. Now, these accounts don't have the same upfront tax advantages, but they can provide flexibility. There are no required distributions, no age restrictions, and they're often taxed at capital gains rates rather than ordinary income. So each type of account serves a different purpose, and this is where strategy becomes so important. You don't want all of your money in one place, you want a mix. So for example, I worked with a client who wanted to gift money to her grandchildren for college. Rather than pulling from a single account, we were able to distribute that across multiple account types, which gave her more flexibility and allowed us to manage her tax exposure more efficiently. We call this tax diversification, and it's one of the most overlooked components of retirement planning. It allows you to adjust how you take income based on tax rates, market conditions, and your personal situation. The earlier you begin building this structure, the more flexibility you can create for yourself in the future. Because the truth is, we don't know what tax policy will look like, and we don't know exactly how markets will behave, but we can prepare for different scenarios. And that's what a well-structured retirement plan is designed to do. Two people can have the same account balance and completely different retirement outcomes based solely on where their money is held and how it's distributed. That's the difference between saving for retirement versus building a strategic retirement plan. Next week, we'll continue to focus on retirement. Now that we've discussed your vision and your account options, it's time to start funding those accounts, and it's important to understand what your options are and how you might be able to maximize them. Today, we took a deeper look at the markets and the economy, going further than we have before, but still in a way that's clear and easy to understand. There are so many aspects of the world you have no control over. The markets, the economy, political events, none of that is something that we can change directly. But you can take accountability for how your financial life is structured. You can take accountability for your portfolio, your time horizon, and your exposure to risk. And ultimately, you decide whether your plan is actually aligned with the life you're trying to build. Next week, we're going to take this even further. We'll go deeper into asset classes, breaking down how they work together inside a portfolio. We'll continue building on the economic side, expanding into quantitative tightening and easing, and how those policies impact the system. And we'll move forward with retirement planning, focusing on how to fund these accounts and how to maximize the opportunities available to you. If this helped bring some clarity to financial topics you're seeing, make sure you subscribe so you don't miss future episodes of Pointe Perspective. where we continue breaking down the markets, the economy, and the thinking behind strategic financial planning. And if you have questions about your own situation, you can always reach out using the contact information below. I hope this offered some useful perspective. Until next week, take care.